Jack Rivkin, CEO, CIO of Altegris Advisors. Great to see you here in Maine at the annual Camp Kotok gathering.
It is great to be here.
And we really can't argue about the weather.
No.
It's perfect. So, on a weather theme, are we looking at some storm clouds brewing in terms of what's happening on Wall Street?
Well, I think what we're seeing are thunderstorms, because I don't believe we're looking for a big, massive storm here. I think we're going to see a series of small storms and quite a bit of dispersion in terms of where the accidents occur and where they don't. I'm not one who believes we're in for a massive correction here. That can always happen, but I think we're more into a period of fairly slow growth. Credit is going to become an issue at some point here, and that's going to cause some accidents. And we're moving into a period where it's not as easy just to buy ETFs or play beta in the market. I think you're going to have to be a little more careful.
And you think that investors might actually not be calculating risk correctly?
No, I don't think they are at all. My favorite line is, past performance is not indicative of future results. That's on the bottom of every report that everyone writes. I actually believe it's now true. The folks that are looking into the past over the last 6 to 15 years are saying those measures of risk and that measure of return represent the basis on which I'm going to allocate going forward, are making a big, big mistake.
Why? What has changed?
Well, what has changed has been this 35-year period of basically declining rates. I was actually in the business when the Fed funds rate hit 21.36%.
So hard to imagine.
Well, it was hard to imagine even at the time as well. But we have been in a downtrend for 35 years plus here. And that's been the wind at your back, both on the equity market as well as the fixed income market. I think going forward, given where we are, and no matter what the path is for how rates increase, they're going to increase. If one is looking at fixed income as the safe haven, I think they're making a big mistake here. And if one is looking at simply buying indices, they're making a second big mistake as well. We're going to see measured dispersion. We've already started to see some of that, certainly what's happened in the energy space. But I think we're going to see it geographically. We're going to see it by sector and even individual companies. We're moving back into a very different environment here.
On the fixed income side first, obviously it's been a chase for yield for so many people.
Yes.
For so long, and that can be problematic.
Yes.
Are you worried about individual bubbles or unhealthy levels in some of the more high-yielding fixed income?
Well, I think that's a problem, because that's where you're going to see the first instances of credit problems as well. And people are chasing yield. They're looking for what's high. They're being told that everything is going to be fine. These folks will be able to refinance. It's not a problem. I don't think it's going to be that simple. Chasing yield, because people have had to do that if they've needed income, is not going to work out very well for people. One is going to have to settle for a lower rate of return, a rate of return that you might even be able to get out of the equity market that is better than the fixed income market in terms of yield. We have an earnings yield that is certainly higher than interest rates, and the dividend yields are at fairly high levels. One could create a very interesting portfolio of dividend yielding stocks who over a long period of time have been increasing those dividends, and they may do better than taking risk on the fixed income market here. Fixed income market is going to have some accidents.
Jack Rivkin, wanted it there. So good to talk to you.
My
Thanks
pleasure.
so much.
Thank you.